Welcome to the virtual gold conference. And ladies and gentlemen, you are in for an absolute treat today. Why? Well, many of you will know the gentleman that is our opening keynote speaker. His name is Mr. Rick Rule. And, you know, I got to say it, Rick Rule rules. And I'm going to say he's the founder of Rule Investment Media. This is a recent one, formerly with Sprott. He's an investigator. He does investigate. He's an investor. He's a speculator. And I love this one, Rick. He's a treasure hunter, ladies and gentlemen. So you have got a treasure hunter as our opening keynote speaker. He's been licensed for 40 years. He knows gold. He knows precious metals. He knows gold equities. And he's going to share some of his views with us today. And the good thing for us is he's now semi-retired, which means he can pretty much say exactly what he thinks. And there's going to be no regulator down his back saying, you can't say that, and you can't say this. Rick Rule, it is such a pleasure to have you as our opening keynote speaker on the August Virtual Gold Conference. Thanks for being with us.
Kerry, it's an absolute pleasure. It reminds me of the first time that I spoke for you at a live conference in Sydney. Yes. I remember that in order to speak, to be your keynote speaker there, I had to walk through a clown's mouth at Luna Park, which my wife decided was very fitting. So it's interesting, the progression in our conferences and what it is. And by the way, that was a fine conference. I did find it rather amusing that a financial conference necessitated entering an amusement park through a clown's mouth. I've always remembered that one.
Yeah, but it was like right on the edge of Sydney Harbour. We wanted to make sure you got the full Sydney experience while you were there. And
it was wonderful.
Who knows when that's going to happen again. Now, on our program, I have you speaking about a crisis of confidence in the fiat currency, and we may have had to prepare for surviving inflation. Before we get into that, can I just get you to speak to our listeners about, you know, what is Rule Investment Media? What are you doing these days? And then we're going to dive into what investors need to look out for in the precious metals market.
Well, Rule Investment Media right now is me talking to an audience of people who care what I have to say. There's 66,000 people who have decided that what I say might have some value around natural resource investing. It also owns a conference. The former Sprott Vancouver Natural Resource Investment Symposium is now, for better or for worse, the Rule Natural Resources Investment Symposium. And so next year, we're going to put on, diseases willing, a live conference in Vancouver with a virtual overlay. In addition, through the course of the year, we are going, sorry about that. Through the course of the year, I think that we're going to put on a series of mini conferences, virtual, which will be themed. Certainly a uranium conference.
I know what you think about uranium. Yep.
Certainly an oil and gas conference.
Okay.
Certainly a silver conference. And probably a gold conference. And these won't be our normal 4-day affairs, but rather 1-day, 8-hour virtual affairs, where we have the ability to get a bunch of veteran speakers, something that you're able to do after 45 years in an industry, and do a sort of a 1-day overview. So I'm really looking forward to doing that. I'm also, Kerry, looking forward to formalizing the feature of my conference, which I like the best, which was the Living Legends. I'm going to do a probably 25-part interview series where I interview for an hour each entrepreneurs who have built multi-billion-dollar natural resource companies from nothing. The idea being to learn what's required to build a company, what lessons the founders learned about building the company that made them better investors, and what lessons investors can learn from the experiences that the founders had. I've really enjoyed that in my conference, but I've never made it a sort of a standalone investment product.
What a great idea.
I want to do. I'm going to offer it for free, so I'm not really sure why I'm doing it other than my own amusement. I'm looking forward to doing that. And then the second thing I want to do, Kerry, is that Wiley and various publishers have been after me for 30 years to write a book about natural resource investing. And I'm not going to do it. I'm not going to do it. I'm going to do probably 30-part, 1 hour video session. That is, I'm going to do 30 hours of videos covering various aspects of natural resource investing that will together be my book. I have found that while people like to read, they assimilate words better that are spoken to them, which is why books on tape do so well, particularly when read by the author. But I've also found that an awful lot of communication is nonverbal. So I believe that to some extent, the book of the future are serialized videos. So the three things that I'm sure for sure that I'm going to do with Rural Investment Media are a continuation of the Vancouver conference, a series of mini conferences, and then a series of interviews, the Living Legends interviews, interspersed with a 30-part serialized how-to course on natural resource investing and speculating. Those are things I'm going to do for sure.
Well, that's going to keep you very busy, but I know in the meantime, you're very good with your time. You're very generous with your time because you love to ensure that people understand resources investing, and you love the precious metals sector. If we can start off, we've got a big investment audience on the program today. I'd just love you to talk about where you think we are in the current cycle, because it is cyclical. Where do you think we're sitting at the moment? Because it's a bit, people are not that excited about it at the moment.
You may recall our last interview, Kerry. We talked about the fact that you can have cyclical declines in secular bull markets.
Yeah.
In fact, if you study the markets, I study the Barron's Gold Mining Index chart, which is the most inclusive and longest running gold equities index chart. You'll find a couple things that are relevant with regards to today's market. The first is that precious metals bull markets are traditionally very long affairs. Their duration is longer than most people think.
What sort of duration are we talking about?
My first one went from 1970 to 1981, so 11 years.
Yep.
My second one went from 2000 to 2011, admittedly with an ugly hiatus in 2008. But again, a decade-long affair. So many investors say to me, Rick, we're 3.5, 4 years into this bull market. Isn't it a bit long of tooth? Have I missed the bucket? Well, if past is prologue, no, we're not even in the second half of it. The second thing that you see when you examine these bull markets and the periodicity of bull markets is that cyclical declines in secular bull markets, while unnerving, are absolutely commonplace. Normally in a bull market, you will experience 3 or 4 fairly severe cyclical declines in secular bull markets. I reminded your listeners, probably much to their chagrin, that in 1975, in the middle of that epic bull market, the gold quote declined by 50% in 9 months, and the equities performed even worse. Speculators who were shaken out by that decline missed the second half of the gold bull market that saw the gold quote rise 8-fold, from $100 US an ounce to $850 an ounce. What we've been through is normal and natural. Well, that might not mollify your listeners' nerves, first of all, because they've suffered through this one, which hasn't been pleasant, but certainly because they're going to have to suffer through a couple more before this market is over. I believe that this particular down cycle in the gold stocks, this particular cyclical decline, is over. I think that we're going to resume the upside now. My reason for that has 5 primary points associated with it. The first is that gold moves particularly because of investors' nervousness about the maintenance of purchasing power of normal savings instruments, which is to say they're nervous about the rate of inflation relative to the return that they're enjoying on their other savings products. In the US context, the increase in the gold price coincided very nicely with the decrease in the yield on the US 10-year Treasury, which is to say negative real interest rates on savings products. With the interest yield on the 10-year Treasury declining from 300 basis points to 60 basis points, the gold price did very well. When the Fed briefly began to reduce yield management and allowed the yield on the US 10-year Treasury to rise from 60 basis points to 150 basis points, gold did relatively poorly. It corresponded nicely. The Fed has begun to untaper, which is to say they've allowed the interest rate or forced the US interest rate from 175 basis points down to 120 basis points. And lo and behold, gold is showing signs of strength. Look at the reasons why investors around the world might be nervous about their purchasing power in conventional instruments. The first, of course, and we've discussed this in your interviews before, is quantitative easing.
Yeah.
If you did that, Kerry, they'd call it counterfeiting. If you were a member of parliament, however, it made you extremely popular and you'd get reelected. That notwithstanding, it's still counterfeiting. The second and more pernicious is debt and deficits. Debts in most major Western countries, Australia included, are unsustainable. And we propose to deal with these debts with budgets that are in deficit, meaning that we add to the debts as opposed to service them. If that doesn't make you nervous about the purchasing power of your savings, what might? Well, I'll tell you what might. Negative real interest rates.
Do you think we're heading there?
I think we're in negative real interest rates.
Okay.
Meaning the yield after inflation.
Right.
Looking at the US 10-year Treasury, which is alleged to be the world's benchmark savings instrument. Sorry to be so American-centric. Right. But the yield on that's 120 basis points in a currency that the Congressional Budget Office, not some cranky old libertarian, suggests is declining by 450 basis points a year. The government is absolutely positively guaranteeing that they will give you 2.75% negative return on your money. In other words, if you give them money now, they'll give you substantially less 10 years from now. In my lifetime, the first promise the government has kept, in fact. My friend Jim Grant refers to that as return-free risk. So gold is competing against return-free risk. And then importantly, Kerry, and we talked about this last time too, is the market share that precious metals enjoys around the world. Precious metals and precious metals related assets comprise about 0.5%, a little less than 0.5% of total savings and investment products in the United States. The 3-decade mean is 1.5%. So if nervousness about the maintenance of purchasing power, in other words, if the arithmetic around savings products just compels investors to return to the 3-decade mean, demand for precious metals and precious metals related equities will triple from current levels. And that's precisely what I think is going to happen. Now, I may be wrong in terms of timing, but my suspicion is the malaise that troubled so many investors, particularly those who were new to the space and didn't have the experience that I have with its vagaries. I suspect that those are over, or if they're not over, that they'll be certainly over in a 3 to 6 month time frame. My suspicion is that they're over now. My suspicion is that you'll see higher lows and higher highs from here.
You talked about the inflationary. Do you think people are even understanding where inflation sits? Because if you look at the way the governments are putting inflation out there, really, and then you look at some of the inflationary aspects of, I don't know, lumber or steel. I mean, I'm looking at some of the share prices down here, like Fortescue Metals Group, which is iron ore, which is going through the roof because the iron ore price is going through the roof. All those things make up, in my opinion, an inflationary environment, but no one's talking about it. Do you think, Rick, that it's a silent inflationary partner at the moment that's going to rear its ugly head, and that's when we're going to see a big spike in not only gold, but also silver?
That's a great question, Kerry. We've been in a circumstance going back to certainly 1982, where inflation has subsided. Corresponds with the great bond bull market. The yield that the US government had to pay to get you to loan them money for 10 years has fallen from 15.6% to 1.2%. So inflation is out of people's minds. People haven't been schooled to be nervous about inflation, particularly those few people in the world who happen to be younger than I am. They've never experienced that circumstance. Two, we have just lived through the most benign financial time in human history. Major equity indexes have gone crazy. The bonds have gone absolutely crazy. And so people have been taught to believe that the big thinkers, governments as an example, have the circumstance under control. 2008, well, they fixed it.
Yeah.
The 2000 tech wreck, well, they fixed it.
Yeah.
COVID, well, they fixed it. But every fix, Kerry, came at a price. Every fix reduced their ability to fix the next one. I would argue that the circumstance that we're in today is not one where the world is solvent, but one rather where the world is liquid. And liquid and solvent are very different circumstances. And I think that people's opinion of the risks of inflation will change. I was speaking to a younger person. Of course, most of the world is younger than me today. But I was speaking to a younger person last week about 4.5% inflation. And he said, well, 4.5%, you know, what does that mean to me? And I said, well, what it means to you is that if you have your money in a savings deposit getting 10 basis points in a currency that's depreciating by 4.5% a year, in 5 years from now, you will have 40% less purchasing power than you have today. How would you feel about that? In effect, that's a tax. That's something to worry about. Australians won't understand this reference unless they've been to the United States. But there's a motel chain in the United States called Motel 6.
Oh, yeah.
And it's called that because when I was a young man, a room at Motel 6 cost $6. And
oh, is that right? I did not know that.
Yeah. Given my economic circumstance then, Kerry, I had more than one occasion to avail myself of a $6 room at Motel 6. The other day, I drove past a Motel 6 up here where I live, and it said Motel 6, $79. Now, there's only two explanations for that. One, a room at Motel 6 could be 13 times as nice as it was when I was a young man, 13 times the size, 13 times better sheets, 13 times better appointments. Or the denominator, which is to say the currency that purchases a room at Motel 6, could have declined by an equivalent amount over the last 40 years. I'll leave it to you to decide what it is, but my suspicion, not that I've had to stay at a Motel 6 recently, is that it's very unlikely that a room at Motel 6 is 13 times the size or 13 times as nice over 40 years. I would suggest that it's a decline in purchasing power. And that's a truly pernicious decline in purchasing power. The US dollar, measured by a room at Motel 6, has lost over 40 years, more than 80% of its value. And that's the perniciousness of inflation.
If I can just ask you this, because does it matter if that price has gone up, if wages have gone up, and if everything, you know, the rising tide raises all boats? Does it really matter? You know, it's $6 then, it's $79 now. You know, when I was growing up, my mother would give me 5 cents, but, you know, she was earning, you know, a few dollars, whereas now it's hundreds of thousands of dollars, and the numbers are just outrageous. No one cares.
Our mutual friend, Bill Bonner, has done a lot of work on this. And Bill measures the number of hours it takes the average worker to buy him or herself a home. It is true that homes are nicer than they were when I was a young man. But that style of home for that price relative to hours worked is no longer available. Similarly, the number of hours per year that a worker must work to buy himself or herself a car. Now, I realize that some of your listeners probably take the bus or take transit or something like that. But for most people, a car is a relatively constant form of transportation. And the fact is that it takes the average worker 3 times as many hours to afford an automobile. Now, yes, it's a nicer automobile, but the less nice automobile isn't any longer on offer for the same number of hours per year that were worked. Probably, Kerry, the most pernicious example is the number of hours per year that you and I work to fund federal, state, and local government.
Uh,
It's interesting to note that when either Australia or the United States publishes the consumer price index, they don't include tax. Now,
really? Okay.
I suspect if I didn't have to pay the tax, I wouldn't bitch so much about the index. But the truth is that that's not on offer. And I suspect that all of these things put together are going to change the inflation dialogue. I think, too, that 4.5% is a starting point. I suspect that any time that there's a financial crisis, that the government will respond to the financial crisis by more quantitative easing.
Yep.
And by more negative interest rates, which will stimulate more consumption and more speculation, which is to say that I think that 4.5% will be a floor rather than a ceiling. But it doesn't matter. You don't need to project higher inflation. All you have to do is hold the 4.5% inflation rate constant against the cost of capital, which is to say 1.2%, and understand that as a saver, you are getting slaughtered in conventional savings instruments. You're not getting hurt, you're getting slaughtered.
Is that why the stock market, because everybody's, and I introduced you right at the beginning as investor and speculator, do you think the speculation is what's driving these share markets into all-time highs?
Well, two things. On investment quality stocks, what you are looking at is the dividend yield relative to other savings products. All of a sudden, equities are paying more than debt. That hasn't happened since the very beginning of my investment career. So people perversely are drawn to bonds for capital gains as they lower the interest rate, and they're drawn to equities for income. But the second thing is that the very high equities prices and the very low price for debt for investment grade issuers means that companies' costs of capital are much less.
Yeah.
If your business is funded 50% with debt, as an example, and your net interest charges falls from 8% to 3%, you're saving 500 basis points in cost against 50% of your balance sheet. So companies have enjoyed a tremendous earnings boost at the same time that those earnings are valued at a different metric than they would have been at higher interest rates.
Does the circus continue, or in Rick Rule's world, is there going to be a moment of truth reckoning and a come to Jesus moment?
You know, Kerry, because I'm by nature a credit analyst, a lender, I always assume that every circumstance out there exists just to screw me. And consequently, I'm very cautious. Doug Casey and I joke that between us, we've called 17 of the last 3 declines. Wow. And I'm always expecting what you would describe a religious experience, a reckoning. I would be surprised if sometime in the next 5 years we didn't have a black swan style liquidity squeeze. Whether it will be as bad as 2008, I can't tell you. But what I can tell you is that every time we've experienced one of those in the last 40 years, the answer has been to pump money into the system. And eventually, the efficacy of liquidity as a tool declines. When you stimulate the economy by pumping excess liquidity into it, what you really do is forward shift demand. You take demand that would have occurred in 2023 and you spend it in 2021, which is great in 2021, but in 2023, you need to replace it somehow. Yeah. And my nervousness is not so much that we will come into a circumstance like that, because we've come into them several times before in my career, but rather how do we exit them? What tools will we have left if we have exhausted to some degree the stimulative impact of negative real interest rates and quantitative easing? That's the thing, if anything, that keeps me up at night.
Well, in the fact that we are living through massive and spectacular market speculation at the moment. And, you know, we see it on social media, you know, what stock are you buying today? What should I put 10,000? I mean, it's comical in a way. Why do you think people should bother with precious metals in such a crazy market and a volatile market?
Precious metals tend to do very well during crises in confidence. Confidence is an all-time high, which seems to me to suggest that it can only go lower, not higher. Every bull market comes to an end. The confidence market coincides with the bond bull market, which is 40 years long. Could it go on 2 more years? Of course. But how much further can it go with the yield falling from 15.6 to 1.2? That suggests that there's been, almost a 20-fold escalation in the bond market. All good things come to an end, including that one. Gold is an asset that's made for times when people don't trust each other. Gold is not a promise to pay, which the US dollar is or the Australian dollar is. Gold is payment. It's an asset that isn't simultaneously somebody else's liability. It's a medium of exchange that's simultaneously a store of value. And it's an asset that does particularly well, as I said before, when people are concerned about the purchasing power of their other savings instruments. Other savings instruments, particularly the sovereigns, be it Australian or US, are uncharitably referred to by my friend Jim Grant as return-free risk. That is, the yield guarantees that you'll lose money. Yeah. And it also assumes that there's no credit quality with the issuer, the Australian government or the US government. But I would suggest a creditor that has debts that they acknowledge that they can't repay is an issuer that does in fact have credit risk, that the lenders, that is to say the savers, you and I, haven't woken up to yet. As a credit analyst, when I look at the US dollar, I think, why would anybody in their right mind lend that issuer money? Now, the answer always comes back because you are their chattel. If they need more, they'll simply extract it out of you. But at some point in time, the goose quits laying the golden egg. And even the fact that the citizens aren't citizen, but rather chattel, as Weimar Germany found out, that party, Kerry, comes to a halt. And by the way, I'm not forecasting any of these dire outcomes. I actually just believe we're going to have, in the current parlance, a reset. And around that reset, around that turbulence, I personally would rather have gold in my portfolio than not. Perversely, Kerry, I hope I'm wrong.
Yeah.
I hope when I shed my mortal coil, whenever that is, I look back and look at the gold which I purchased as insurance as something that cost me premium, as opposed to shield me from a very unpleasant event. But I think I'm right at the same time that I fear I'm wrong.
You've said in the past that you've looked at people's portfolios when they're looking at gold stocks, for example, and you say it worries you when they go all in. So you're not suggesting that people sell their house and their children and go all in gold. You're just saying it's, as you said a moment ago, it's an insurance policy. We hope that it doesn't get to that. But
it's a cheap insurance policy. You don't have to overinsure. When the set of circumstances happens that makes gold prices go up, they go up a lot.
Right.
What you've seen so far is the down payment, Kerry. Let's look back at 2 prior gold bull markets. The 1970 bull market, admittedly from a price-controlled base.
Yeah.
In US dollar terms, $35 to $850.
Mm-hmm.
A better example would be the 2000 bull market, 2000 to 2011, from 253 US dollars to 1900 US dollars. So what is that? My arithmetic off the top.
Yeah, I was just about to say,
it's a 6 or 7-fold increase.
Yeah.
So people now look at the market and they say, well, Rick, this market started at 1,000. It's already at 1,800. Have I missed the boat?
Yeah.
Both in terms of duration, 10 years rather than 4, the answer is no, and dimension. 1,000 to 1,800 rather than 250 to 1,900? The answer is no. Am I saying that gold is going to go to 6,000 or 7,000 or 8,000? I'm not saying that, but to be honest with you, it wouldn't surprise me, because I think that they are going to accelerate the pace of the deterioration of fiat currencies, yours and mine both.
Mm. But, you know, right now, I mean, if we go back to 1971, and we all know the story of Nixon taking the dollar off the gold standard, and that allows them to keep printing. Aren't we living in a completely different, it's almost like a parallel universe where it doesn't really matter, Rick? It's not backed by anything. We'll just keep printing. The numbers will go up. You know, a burger might be $50, you know, in years to come, but no one will care because I'll just keep giving you more of the stuff. And maybe universal basic income will come in, and who cares?
That attitude was based, I think, on the period 1980 to 2020, which was, I believe, the most benign financial epoch that anybody has ever lived in. It reminds me of, and I forget who the quote was from, how do you go bankrupt? Well, in the beginning, slowly, very slowly. And then at the end, very rapidly. Right now, Australians aren't concerned about the credit quality of the Australian government. They aren't concerned about the deficits. They aren't concerned about what would happen if demand for Australian coal or Australian steel evaporated. But they should be. I'm not saying it's going to happen, but I think that the possibility of it is high enough that people who don't insure against that contingency are either innumerate or just plain stupid.
Well, here in Australia, Rick, everyone's just focused on property. You know, everyone's just like, well, the property market's going up and up and up and up and up. And
I love that. I get that question from, 40 or 50-year-old investors all the time. And I say to them in US dollar terms that traditionally the yield on the US 10-year treasury has been 150 basis points positive. So if the CPI stated rate of inflation is 4.5% and you add 150 basis points on that, that means that if we had a free market interest rate, the kind of interest rate we had prior to 1990, that the US 10-year treasury would be yielding 6%. Traditionally, the first mortgage rate is 100 to 150 basis points higher than the US 10-year treasury, which means that in the US, we'd have a 7.5% first mortgage rate. If we had a 7.5% first mortgage rate in the United States rather than a 2.75% mortgage rate in the United States, that would take care of the problem of expensive housing. If the cost of owning a house measured by the interest that you paid went up by 150 or 200%, the affordability of homes and hence their prices would have an interesting circumstance. Think what might happen in Kerry if the mortgage interest rates in Australia more than doubled. Think what that might do to housing affordability and hence housing demand.
Well, I've gone through that note in my head, but at the moment, what the Federal Reserve down here is saying, oh, no, don't worry, we're not going to touch interest rates for at least another 3 years. So
and it's interesting. It's interesting that we believe in their ability to sustain the fiction that we've believed. If they actually believe that quantitative easing is good for the economy, why do they charge tax, Kerry? Why don't they just print the money? If we have enough faith in the big thinkers in government that we believe that they can fine-tune the economy with quantitative easing, then there's no need for tax. We can just conjure up all the money we need. By the way, it's been tried before. There was a financial genius who I think should be Secretary of the Treasury in the United States. His name was Gideon Gono. He ran the Central Bank of Zimbabwe. They couldn't collect any tax because the only people who were making any money were government people, and they refused to pay the tax, so they just printed. They got pretty good at printing. In fact, they got so good at printing that they only put ink on one side of the bill, and they actually had an expiration date. So the logical extreme of the point of view that people are espousing now is simply that the big thinkers meaning your government and my government run the world,
Yeah.
that confidence in their efficacy is such that they don't have to tax people anymore. They can spend on whatever they want, and they can conjure up payment for that by the printing press. In fact, that's an economic experiment that's taken place before.
Yep.
The predecessor to Adolf Hitler in Weimar, Germany, tried it.
Yep.
Didn't work out so well. Argentina has tried it 2 or 3 times with predictable results.
Well, it leads me to just, I have to ask you this, Rick, and I don't know what your views are on this, but all this digital, we've got the cryptocurrencies and we've got governments turning around and saying, well, we're going to create a digital coin and we're going to track and trace everybody. That's how we're going to be able to tax you and prop up our government spending for eternity. What are your views on that?
Well, 3, I guess. In the first instance, if you believe in government, then they shouldn't have to tax. They can just counterfeit. Their promises are a little disingenuous. I certainly believe that a government cryptocurrency is the most pernicious investment in the history of mankind, because the government can track your access to currencies. In other words, there's no savings asset that they don't control. And if they think that we've been bad boys or girls, they can cancel it.
Absolutely.
The Chinese government right now is assigning social scores to people. Can you imagine if the Chinese government could rate you on your political correctness and destroy at their will 1/3 of your savings or all of your savings because your actions weren't in their interest? I actually believe that government-sponsored cryptos is the single most threatening economic development of my life.
Yep.
Mankind does well when we focus on individual initiative. When we act as individuals, we can generate so much wealth that we actually, for several thousand years, have been able to afford our collective stupidity. When you thwart the triumph of the individual over the institution, I believe, this sounds dire, but I believe that you've begun to sow the stage for at least revolution, if not extinction. I'm long range. I'm a real optimist, because I've seen how much wealth can be created by individuals serving markets. Yeah. I take delight in 6 youngsters commandeering a garage in Sunnyvale, California, and out pops Google. Yeah. It's absolutely wonderful. But if the government has the ability to say that, freedom of speech, as an example, is harmful, or Google's harmful, or all those things are harmful, and they have the ability at a whim to cancel Google's earnings by redeeming the currency that's in their bank account with the click of a mouse for unpatriotic or politically incorrect activities, that gives the government the final ability to control humans and limit their creativity. And that's very dangerous. I don't think it's going to happen. But since you asked,
I hope it doesn't.
Since you asked the question.
Yeah. Rick, you've said in the past, because you briefly touched on capitalism, you said that capitalism is important to a secure future. If we can just touch on that, and then I want to go into the psychology of investing and then talk about gold equities. So why is capitalism important to a secure future?
What capitalism is the return that risk takers and savers get by providing goods and services. Kerry, if you get me to come to your conference back when you had physical conferences and you charge me $500 or whatever it is that you used to charge, you have to convince me that I'm going to get more than $500 worth of value. And if I come back the second year, it's proof that I got more than $500 worth of value. If you can get $500 from me and your cost of servicing me is $300 and you make $200, you made that $200 because you provided me with a service that was worth more to me than the $500 I spent. Your profit is the excess of service that you delivered to society to your customers that was in excess of the cost of providing that service.
Mhm.
The nature of capitalism is that the surplus, which is to say the capital, is the excess of utility generated relative to utility employed. It's as simple as that. When people talk about these billionaires, the Bill Gates of the world, the Jeff Bezos of the world, and they say that they owe society something, that's horseshit.
Yeah.
The fact that they've made billions of dollars is testimony to the fact that people have voluntarily given them billions of dollars because the service that they have generated is worth more than the savings are to the individuals who gave it up. That's the nature of capitalism. But capitalism is more. After the entrepreneurs have made the money, and that capitalist, he or she deploys their capital, they allocate that capital to other people. They loan it to them, they invest in them, so that it becomes a virtuous circle. Jeff Bezos understands enough about technology that he makes 100 seed stage investments in technology deployers. In other words, he employs his capital. He makes his money make him money. And by doing that, through trial and error, through this messy process called a market, the capital recycles itself intelligently, not efficiently necessarily, but intelligently. The wealth that's created in the world is simply the excess of utility generated relative to the utility consumed. That's all it is. And the delta is expressed as capital.
Got it. I'm conscious of time. I'm conscious of our audience. Rick Rule, you have so much experience in investing. There are people listening today that are saying, all right, what do I invest in? What is Rick Rule doing who's been successful? Is he buying the physical gold? Does he like silver? Does he think silver is going to go? Now, there's a lot of questions, but I want to dive into what you're looking at the moment and where you think, because you're a contrarian investor as well over the years. So do you think now is a good time? I mean, the gold equities are not outperforming as well as others. So what advice would you give people listening today, sitting here, and there are people from all over the world listening?
Sure.
What would you say to people about the current market that we're in and where and how you would not only grow your wealth, but protect it?
Well, first of all, if you don't own some physical gold, strongly consider getting some insurance. Buy it and hope it doesn't go up in price, because it goes up in price when the rest of your portfolio gets whacked.
Okay.
The second thing is, in a market where the gold equities are off 25%, if you think about that, 25% off in price is a sale. Is a sale a bad thing? The gold equities, by many metrics, in particular, the net present value of future cash flows relative to enterprise value, are as cheap as they've ever been in my career. So own them. Speculators, I think, need to consider owning silver stocks, because in the later part of a precious metals bull market, silver does well. I'm also, particularly at this juncture, interested in oil stocks. The big thinkers of the world, the Bidens, the Trudeaus, the Merkels, the Greta Thunbergs, don't like oil, but the rest of the world does. Irrespective of narrative, they like the utility in oil. And oil companies at $60 West Texas Intermediate do very, very, very well. So if you believe, Kerry, that people are going to continue to drive for a while, which I do, the oil stocks are quite cheap. Quite cheap. I'm attracted to, now that I'm not regulated anymore, I can name some names. For investors who aren't overly involved in natural resources, companies that are in and of themselves contrarian and generating lots of free cash, I think are attractive. A year ago, I told you on your show that Australian investors probably needed to look no further than BHP and Rio.
Yeah, you did.
Now the name that comes to mind is Glencore. Everybody hates Glencore, in particular because they generate so much cash from thermal coal.
Yeah.
And people hate coal, except for people who want the lights to go on. People don't realize that the record year worldwide for coal demand was 2020. And 2021 is going to eclipse it. The big thinkers notwithstanding, there's 600 coal plants under construction around the world. This is a declining industry, we're told. Many institutional investors who are using other people's money, not their own, want to be green. And so they're disinvesting from the coal business.
Yeah.
Glencore says that we won't have a coal business in 30 years, but that gives them 30 years to make money on it.
Right.
They are the largest shippers of thermal coal in the world. They recently bought 60%, I guess, of a coal asset that they didn't own, thermal coal asset, and they paid 1.5 times cash flow.
Wow.
For a 30-year reserve. How would you feel about a 1.5-year payout, which is to say 40% compound internal rate of return?
Wow.
For an asset that you'll be producing for the next 30 years? You look beyond coal in Glencore, and I'm not trying to say there aren't political risks in Glencore. They operate in a whole bunch of places where the faint don't tread.
Yeah.
But interestingly, you find them in cobalt, you find them in coltan, you find them in copper. You find them roundly hated, which means that on an enterprise value to EBIT basis or an enterprise value to net present value basis, they're cheap. Importantly, too, the officers and directors were founders. They're very large shareholders. What you find when the management teams are large shareholders, that for some odd reason, they're usually fairly shareholder friendly. These guys are rich guys. They spend a lot of money and they like dividends. You know what, Kerry? I like dividends too. Yeah. So I'm not suggesting necessarily that your audience go to Glencore, although I wouldn't not advise it. What I would urge them to do is regard Glencore as a point of discussion. That you need to look beyond the narrative. You need to look at free cash generation. You need to look at companies who are smart enough to understand that although coal won't be a business 30 years from now, it's a hell of a business right now. And right now is when we live. In natural resources, as you stated, if you're not a contrarian, you're going to be a victim. So you have to look for things that are out of favor, not in favor. You have to look for markets that have fallen by 50%, not increased by 50%. You have to look for the factors behind a bull market and behind a bear market, and look for circumstances where the factors that are shaping other people's perceptions are coming to a halt, and a different set of perceptions is coming to the fore. Buffett famously said he became rich by being brave when others were afraid, and afraid when others are brave. If the price of something triples, we're all brave because the price action has justified the narrative, right when the value has come out of it. By contrast, when the price of something falls by 50%, in fact, when the price of something is below the cost to produce it, but demand is assured, there's only one answer as to what can happen. The price has to go up. Mm-hmm. So being in circumstances that are unpopular, where it's certain that it will become popular again, the answer is clear if you have the courage to employ it.
My final question to you, Rick, is over the years, you've been extremely successful. You're known very well in the precious metals market. Has your success come from having strong hands when others have had weak hands? In other words, I think, you know, the psychology of investing means that people see something fall and they're like, they panic and they get out. Has your success come from looking at that and saying, I have strong hands, I'll stay the course? Partly
that. Speculators. I've had investment success and speculative success. I'm known for speculative success. Mm-hmm. Speculative success requires a tolerance for failure. You need to lose 20% and 30% several times on your way to finding something that's going to go to 1,000%. And allowing yourself the strength to bear psychologically the risks of some fairly small financial losses in hopes of extravagant gains. That's required. Duration is required too. I think almost every 10-bagger I've ever enjoyed took 5 or 6 years. Many speculators who don't know enough about what they buy have trauma holding stock over a long weekend. And that's not how fortunes are made. And you have to, as you suggest, have strong hands. My most extravagant investment success in Australia came at the hands of our mutual friend, John Borshoff, in Paladin. I bought Paladin at a dime and saw it promptly go to a penny. I was 90% off.
Right.
When you're down 90%, Kerry, there's no such thing as a hold. It's either a buy or it's a sell, one of those two. Mm-hmm. Re-examined my premise, decided that I was right, the market was wrong, bought a bunch more, and saw the stock go from a penny to $6 in 6 years. The point of it isn't the gory headline. The point of it is that the price of Paladin during the time I owned it fell by 90% once and 50% twice on the way to registering a gain from my original purchase price, 10 cents to $10. So having the tenacity and the confidence, if you're willing to do the work and understand the value proposition, is a necessary part of being a speculator. Being an investor just relies on contrarian instincts and patience. Compounding money requires leaving the money in place long enough for it to compound. You know, that's really all it takes. Now, with natural resources, they're cyclical. So as an example, you have to buy BHP when people don't want to be in the iron business.
Yeah.
Everybody wants to be in the iron business right now. BHP is probably okay to hold because they generate a lot of free cash. But there was a point in time, I remember in 1999, when I was able to tell penny stock speculators, never mind the penny dreadfuls. BHP is going to give you 300 or 400% returns, and it's going to pay you 6% dividend while you wait. That's the stuff of investment success, buying the best companies in the world when they inhabit sectors that are unpopular, and then hanging on for dear life.
Yeah. All right, Rick Rule, we're running out of time, but I'm going to leave the last word to you because I'm sure you've got some last comments, and also sometimes you do some ratings for people and stuff like that. So
yep. I want to do the rankings.
Hey, what's that?
Go ahead. You go ahead, Kerry.
No, last word is yours.
Fine. Love your audiences, first of all. I've enjoyed every conference you've ever done, including being subjected to the indignity of walking through the clown's mouth. In order to deepen my conversation with your audience, I'm going to bribe them. If you go to a website, sprottusa.com/rankings, and you list your natural resource investments, please no cryptos, please no technology, please no pot stocks. I will rank those stocks 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. And if you mention charts in the question and comment line, I will include the Barron's Gold Mining Index, which is the best pictorial representation of precious metals equities bull markets I know. And I will include another chart that every Australian should have pinned on their wall, which is a 100-year chart of the prices of industrial commodities like iron and coal and wheat relative to other asset classes in the world economy going back 100 years.
Wow.
In a commodity-centric economy like Australia, not being familiar with the ebbs and flows of commodity cycles is, I think, a basic mistake.
That is extraordinarily generous. I'm excited to get one of those. Rick Rule from Rule Investment Media, as I said at the start, investor, speculator, and treasure hunter. Thank you for joining us on the virtual Gold Conference today.
Well, thank you for having me back, Kerry.